Hi everyone, in this video we'll be going over A-Level Accounting 2022 October-November paper 2 and question number 2. So this is a structured paper 2 which consists of 4 questions and 2 of them are of 30 marks whereas 2 of them are of 15 marks, and we're also given a time limit of 1 hour and 30 minutes. And this question number 2 is of 15 marks, which means that ideally we should be spending about 15 minutes in order to solve this question. And in this video as well, we will be attempting to solve this question under 15 minutes. Now without any further delay, let's get started. Bharati owns a small business. The following information was extracted from her accounting records. We're given the balances at 1st July 2021. We're given the cost and provision for depreciation of the delivery vehicles. We're also given the extract from asset register. And we can see that there are 2 delivery vehicles, DV1 and DV2, which was purchased at the date of 1st July 2019 and 1st July 2020. And we're also given their cost. Alright. Then on 1st October 2021, Bharati purchased a new delivery vehicle DV3 costing 26,000. She paid 14,500 by check and the balance was settled by part exchange of the old delivery vehicle DV1. Bharati depreciates delivery vehicles using the straight line method on a month-by-month basis, and the estimated useful life of all delivery vehicles is 5 years with no residual value. Okay, so let's talk about the new delivery vehicle. Its cost is 26,000, and out of 26,000, 14,500 was already paid by check. And we are told that the remaining balance was settled by part exchange of the old delivery vehicle. So let's figure out the value for the part exchange. That is just going to be the difference between the cost, which is 26,000, and the amount paid by check, which is 14,500. So the part exchange value will now be 11,500. Then we're also told that the delivery vehicles is depreciated using the straight line method on a month-by-month basis, and we're not given any rate, but we are given our estimated useful life of 5 years, and we're also told that there is no residual value, which means that we can easily figure out the depreciation for all of our delivery vehicles. Let's first figure out our depreciation for each delivery vehicle per month, because we're told that the depreciation is being charged on a month-by-month basis. Okay, let's start with our delivery vehicle 1. So depreciation per month. Now for delivery vehicle 1, we're given the cost to be 18,000, so that's going to be 18,000, and we're told that there is no residual value, so we subtract 0, and then we divide it by our estimated useful life, which in this case is 5 years. Now remember that this will give our depreciation charge per year, but we're trying to figure out the depreciation charge per month. So if we just divide the depreciation charge per year equally among the 12 months, we will be getting our depreciation charge per month, right? So I'm just going to divide it again by 12. And this gives the depreciation per month for delivery vehicle 1 to have the value of 300. Now we repeat the same process for delivery vehicle 2. We have our cost to be 34,000 right here. So that's going to be 34,000 minus the residual value of 0 divided by our estimated useful life of 5. And since we're trying to figure out the depreciation per month, we're again going to divide it by 12. And this gives the depreciation charge per month for delivery vehicle 2 to have the value of 1,700 by 3. Now let's repeat the same process for delivery vehicle 3. We have our cost to be 26,000. So that will be 26,000 minus 0 by our estimated useful life of 5. And since we're trying to figure out the depreciation per month, we will be dividing it by 12. And this gives the depreciation charge per month for delivery vehicle 3 to have the value of 1,300 by 3. Okay, now let's have a look at our question. We first need to prepare the following ledger accounts for the year ended 30 June 2022. First of all, we need to prepare the delivery vehicle's cost account. And we know that delivery vehicle is an asset, and the opening balance of an asset is always to be recorded on our debit side in the ledger account. So we will have our opening balance right here. Let's write it down. So that will be balance BD. And we're told that the end year is 30 June 2022, which means that our opening date is going to be 1st July 2021. So that will be 2021, 1st July. And we are preparing the delivery vehicle cost ledger, which means that the opening balance should include the cost of the existing delivery vehicles. And at the date of 1st July 2021, our existing delivery vehicles were delivery vehicle 1 and delivery vehicle 2. So the total cost to be included as our opening balance will be 18,000 plus 34,000, which results in 52,000. Let's write it down in our ledger. Now, we also know that we purchased a new delivery vehicle, right? So that should also be mentioned in our delivery vehicle's cost ledger account. And since this increases the balance of the total cost, we should be recording it on the debit side. So let's write it down. We know that the date of purchase was 1st October 2021. So that will be 2021 1st October. And this new delivery vehicle was partly funded by the check, which means that we need to record this amount of 14,500 under the heading of bank, and partly funded by our part exchange of 11,500, which means that this amount of 11,500 must be recorded under the heading of disposal account, because we are basically disposing our delivery vehicle 1 in order to get this delivery vehicle 3. Let's write these two amounts. So we have bank with the amount of 14,500 and the part exchange value, which should be mentioned in our disposal account. And it has the value of 11,500. Now remember, while purchasing the new delivery vehicle 3, we also got rid of our delivery vehicle 1. So the cost of the delivery vehicle 1 should be now deducted from our accounts, right? And the reduction in value of the cost should always be recorded on the credit side. So now we will be recording it right here. And it was also part exchange at the date of 1st October. So the date is 2021 1st October. And since we are disposing our delivery vehicle 1, the heading under which we should be recording the cost of delivery vehicle 1 is disposal account. Let's write it down. And from above, we can see that the cost of the delivery vehicle 1 was 18,000. So let's write this amount in our ledger. Now this concludes all of our transactions made towards the cost of the delivery vehicle, which means that we can now figure out the closing balance, which is at the date of 30 June 2022. So let's write it down. That's going to be 2022, 30 June. And that is our closing balance. So that's balance CD. Now this closing balance acts as a balancing figure, and in order to figure out the balancing figure, we first require our total. So we can just figure out the total by adding these three amounts from the debit side. That's going to be 52,000 plus 14,500 plus 11,500, which results in 78,000. And the total is going to remain the same for the credit side as well. Now in order to figure out the balancing figure, we just need to subtract this amount from the total. In this case, that's 78,000 minus 18,000, which results in our closing balance to have the value of 60,000. Okay. Now the last step to remember is that we need to write down our closing balance as the opening balance for the next date. So that will be on the opposite side. And now the date is going to be 2022, 1st July. This will be the opening balance. And this year's opening balance is going to have the same amount as last year's closing balance. So we just need to copy this amount of 60,000. This concludes our delivery vehicle's cost account. Now we can move towards the next one. Now we need to prepare the delivery vehicle's provision for depreciation. Okay, so provision for depreciation is something that reduces the assets balance, right? Which means that the opening balance for this account should always be recorded on our credit side. And the opening date is 2021, 1st July. Let's write it down. And this is our opening balance. Now this opening balance should record the accumulated depreciation of our existing delivery vehicles at the date of 2021 1st July. And at this date, we had the delivery vehicle 1 and delivery vehicle 2. So we just need to figure out its accumulated depreciation. Now let's figure out our accumulated depreciation from the above information. We already figured out that the depreciation per month for delivery vehicle 1 was 300. And we can see that the date of purchase is 1st July 2019. And from this date till the date of 1st July 2021, there is a time frame of 2 years, which means that the accumulated depreciation for delivery vehicle 1 is going to be the depreciation charge for 2 years, right? So let's figure it out. We have our per month charge of 300. If we multiply it by 12, we get our depreciation charge for 1 year, but we require the depreciation charge for 2 years. So we're just going to multiply it by 2 again, which gives the total accumulated depreciation for delivery vehicle 1 at the date of 1st July 2021 to have the value of 7,200. Now we just repeat the same process for delivery vehicle 2. We can see that the per month depreciation charge is 1,700 by 3. And the date of purchase of this vehicle was 1st July 2021. And from this date till the date of 1st July 2021, there is the time frame of 1 year, which means that our accumulated depreciation for delivery vehicle 2 is going to be the depreciation charge for a year. And this is the depreciation charge for 1 month. So we're just going to multiply it by 12 in order to get the depreciation charge for a year. This gives the accumulated depreciation for delivery vehicle 2 to have the value of 6,800. Now we can just figure out the total accumulated depreciation to be recorded as our opening balance. That will just be the sum of these two amounts, 7,200 and 6,800. So that's 7,200 plus 6,800, which results in 14,000. So this is the opening balance to be recorded in our provision for depreciation account. Let's write it down. That is 14,000. Now the next thing that increases our provision for depreciation is the depreciation charge for this particular year, which will be recorded in our income statement, right? So that increment should be recorded on the credit side. Let's write it down under the heading of income statement. And this will be recorded at the ending date, which is 2022, 30 June. Now let's have a look above and figure out the depreciation charge for this year. Okay, let's start with our delivery vehicle 1. We know that the depreciation is being charged on a month-by-month basis, right? And this delivery vehicle 1 was disposed on 1st October 2021. So the number of months that we use this vehicle in the year ended 30 June 2022 is going to be July, August, and September, since we're disposing it at the date of 1st October, right? So we just need to record the depreciation for 3 months. Let's figure it out. The per month depreciation is 300. We can just multiply it by 3 in order to get the depreciation to be charged in the income statement. So that will be 900. Let's figure it out for delivery vehicle 2. Delivery vehicle 2 is being used for the entire year, right? So let's figure out the total yearly depreciation. That's 1700 by 3, which is the monthly depreciation. And we can just multiply it by 12 in order to get the yearly depreciation, which results in the value of 6,800. And then we have our third delivery vehicle. And this third delivery vehicle was purchased at the date of 1st October 2021. So the number of months that we use this vehicle for the year ended 30 June 2022 is going to be October, November, December, January, February, March, April, May, and June. So that gives us 9 months, which means that we should be including 9 months depreciation for delivery vehicle 3 in our income statement. So we have our per month depreciation to be 1300 by 3. And in order to figure out the depreciation charge for 9 months, we can just multiply it by 9, which gives us the value of 3,900. So the total depreciation to be charged in our income statement is just going to be the sum of these three amounts. That's 900, 6,800, and 3,900. So 900 plus 6,800 plus 3,900, which results in the value of 11,600. Let's record this amount in our ledger. Now the next thing to be recorded in our provision for depreciation account is the total accumulated depreciation of the disposed asset. And in this case, we can see that our delivery vehicle 1 is being disposed at the date of 1st October 2021, which means that we need to record its total accumulated depreciation on the debit side, since it reduces the total provision for depreciation, right? So let's write down the date. That's 2021, 1st October. And since we're talking about a disposed vehicle, this should be recorded under the heading of disposal account. And we should be recording the total accumulated depreciation at the date of 1st October 2021. So let's figure it out. We've already figured out that the accumulated depreciation at the date of 1st July 2021 is 7,200 for delivery vehicle 1, and the depreciation charge for the year ended 30 June 2022 is 900. So the accumulated depreciation at the date of 1st October 2021 is just going to be the sum of these two amounts. That's 7,200 plus 900, which results in the value of 8,100. Let's record this amount in our ledger. So that's 8,100. And this concludes everything to be included in our provision for depreciation, which means that we can now figure out our closing balance at the date of 30 June 2022. And since our opening balance is on the credit side, the closing balance will be recorded on the debit side. So that will be 2022, 30 June. This will be our closing balance. And in order to figure out this closing balance, we first require the total, right? So we can easily figure out the total by adding these two amounts from the credit side. That's going to be 14,000 plus 11,600, which results in 25,600. This will be the balance on the debit side as well. Now the closing balance acts as the balancing figure, and in order to figure out this amount, we just need to subtract this amount from the total. In this case, that's going to be 25,600 minus 8,100, which results in our closing balance for the provision for depreciation account to have the value of 17,500. Again, the next thing to remember here is that we need to record our closing balance as the opening balance for the next accounting period. So that will be on the opposite side at the date of 1st July 2022. So this is going to be our opening balance now. And it's going to have the same amount as of the closing balance for last year. So that's going to be 17,500. This concludes our provision for depreciation account. We can now move towards the next one. Now we have our disposal account. So disposal account only records the asset that we're getting disposed of, right? And remember that whenever we're preparing a disposal account, we start with the cost of the disposed asset. And in this case, we are disposing the delivery vehicle 1, right? And its cost should be recorded on the debit side. And the date will be the date of disposal, which is 2021, 1st October. We're recording the delivery vehicle cost. Let's have a look above. We can see that the cost of the delivery vehicle 1 is 18,000, so we need to record it in our ledger. Let's do that. Now the next step in the disposal account would be to record its provision for depreciation and sales proceeds on the opposite side, which is the credit side, right? So the date is again going to be that of 2021, 1st October. We're going to record the delivery vehicle provision for depreciation. And we've already recorded it in the provision for depreciation account. So we can just copy that amount. Right here, we can see that for the disposal account, the provision for depreciation was 8,100. So let's copy this amount. And nextly, we need to record the part exchange value, right? Because we did not sell it, we part exchanged it for a new vehicle. Let's write it down. That will be delivery vehicle part exchange value. And again, this is also recorded in our delivery vehicle cost account right here. The disposed assets would part exchange for the value of 11,500. So let's copy this amount. Now we need to compare both sides in order to figure out which one is the heavier side and to see if there was a profit on disposal or a loss on disposal. We can see that the total for the debit side is 18,000 and the total for the credit side is the sum of these two amounts. That's 8,100 plus 11,500, which results in the value of 19,600. So we can see that the credit side is heavier, which means that the balancing figure should be adjusted on the debit side. So the total will be that of the heavier side, that's 19,600. On both sides. Then we need to adjust in our income statement because this is basically going to be the profit on disposal because we're getting a higher value as compared to our cost, right? And it should be under the heading of income statement. And in order to figure out the balancing figure, we just need to subtract this amount from the total. In this case, that's going to be 19,600 minus 18,000, which results in our profit to be recorded in the income statement to have the value of 1,600. This concludes our disposal account. Now we can see that we're given the working section right here, but as you can see above, I scribbled all over the question paper to do all of my workings. But instead of doing this, you guys should be showing all of your workings in that particular box so that you get your markings correctly. Okay, now we can move towards the next part. For the second part, we need to state one reason why non-current assets are depreciated with reference to an appropriate accounting concept. So an appropriate accounting concept would be the matching concept because we need to match our expenses to the revenue, right? And we're talking about non-current assets. So the justification could be that the revenue generated during the accounted period by the use of our non-current assets should match the expense of the depreciation of that particular non-current asset under our matching concept. Let's write it down clearly. To match the expense of depreciation with the revenue generated during that accounting period in accordance with the matching concept. Now for the third part, we need to explain one difference between capital expenditure and revenue expenditure. So capital expenditure is basically the expenditure on non-current assets, whereas revenue expenditure is our day-to-day running costs. Let's write it down. Capital expenditure is expenditure on non-current assets, whereas revenue expenditure is the day-to-day running costs. Okay, now for the fourth part, we need to state one example of a capital receipt. So capital receipt just means that our capital is increased. So that could be done by capital introduced or cash introduced, right? Let's write it down. Capital introduced or cash introduced. Then we have our revenue receipt, and revenue receipt is basically our income received. So the incomes could be rent received or commission received. Let's write it down. Okay, so this concludes the question number 2 of 2022 October-November paper 2-1. If you found this video useful, make sure you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.